the word passive is a very frustrating word to see from my standpoint, because especially for the ones I know are not passive, because passive implies mailbox money, sit on your couch and you send them money and then get a check. And a lot of them, I know good and well they are completely not passive, and then they market it as like passive income, and that's just wrong. I mean, it's just incorrect. It's a lie at the end of the day. Welcome to Finance for Physicians, the show where we help physicians like you use money as a tool to live a great life. I'm your host, Daniel Wrenne, and I've spent the last decade advising physicians on their personal finances, with the mission to help them understand that taking control of their finances now means creating a future where they can practice medicine where, when, and how long they want to. Hugh, how's it going, man?
Great, Daniel. How are you doing?
It's going good. We hadn't gotten on for a bit, so I'm excited to catch back up and talk a little shop. We were just chatting before we hit record about this fantastic investment opportunity uh, that we've known about for quite a while, but um, we were looking at the numbers for it, and I guess kind of admiring how solid it looks, right?
Yeah.
Pretty good
Yeah. I mean,
deal.
so what if I told you that there was a passive investment that returned $75,020 for every 100,000 that you invested 5 years ago? Does
So
that
do
pique your
do those
interest?
numbers again. That's
$75,020 for every $100,000 that you invested 5 years ago.
so that's a 75% return, right?
Yeah, over 5 years. Yeah.
Yeah, that's pretty
Sound
good.
good?
Yeah, what's that annually? That's 10 or
We'll
8.
we'll link to that in the show notes, but it's 11 point something.
Good. We'll just say good.
Yeah, good, good. The other cool part about it, it could be tax deferred, it could be tax free, depending on how you do the investment.
This is a very
With those,
passive investment, like you were saying. Truly
that's right.
passive. From this, when he said passive, he meant like no work required, buy, hold. It does you're not getting your hands dirty. I
Yeah.
think. Is that what you meant by passive? There's also another passive, like as in it owns the entire market, but I assume you're meaning that
Right. So you don't have to take out a loan. The minimum investment is only $1,000. You can
no
withdraw
LLC.
your money in a few days' notice.
Yeah, super liquid.
Right. Yeah. I mean, in fact, it's so proven to work, right? You know how regulated the investment industry is, right? It's
Mm.
very hard. We get a we have a lot of regulatory oversight, and it's so proven that even your employer is allowed to automatically take part of your paycheck and put it into this investment if you don't make any choices for yourself.
Mm.
So that last hint
Oh,
probably gave it away.
yeah.
What we're talking about here is the Vanguard 2060 target date fund. So not sexy, it's pretty boring. But if you just look at the numbers, 75,000 bucks roughly over the last 5 years for every 100,000 you invested, not too bad.
Yeah. Well, getting above 10% a year, it's got to be above 10% a year if we annualize it, but getting 10 plus percent per year is actually pretty challenging over longer periods of time. I'd say it's pretty uncommon. It's interesting. Even the investments we see that have required a lot of effort oftentimes are not doing that. Um, and or the investments you would think would be doing that are not doing that. So comparatively, that's a pretty solid return. Now it's not well. So we're going to be talking about all the alternatives out there, but I think the question is like, why wouldn't everybody put all their money in that? And a lot of people are putting their money into that because that's what's happening automatically to your work retirement plans. Like Vanguard Target Retirement Date Fund or whatever target retirement date fund is a lot of people's options for their retirement plans, and that's a good option. But there's plenty of people putting a lot of money in different alternatives to that, and that's what we're going to be talking about mainly today is the alternatives, because and the temptations, I guess you could say, or the shiny objects. Um,
Yeah. Yeah, I went 75% a year, not
right.
5 years.
Or a week.
Yeah.
Yeah.
Right? That would make everything better, right? All the problems would go away.
Right. But I mean, like, it's also a question of what's reasonable. So, like, um, if you do the math on what we do retirement projections kind of like as our job, so we get to see all these numbers a lot, like you and I. So we get a little more exposure to it. But like when you start to look at the long-term projections, the difference between like 7% annually for the rest of your life versus 8 versus 9 versus 10 versus 15 or 20, it's like in exponentially higher. Like if you're getting 20% return every year, you're going to be, and you're saving the average savings rate, you're going to be uber loaded. And nobody's really doing that. I mean, it's extremely rare. So I guess my point is that a lot of times there's this question of what do you actually need, like to return? And it's not typically that high of a percentage. Like, so a lot of these temptations and shiny objects, we're going to kind of talk through. You don't actually even need to, like this Vanguard target retirement date option can typically do the job pretty easily.
Right. And before we lose anybody, because we've been we've talking about target date funds, I mean, I know you want your money to work as hard as it possibly can for you because you do a tough job. Sometimes it's hard to see a way out and you're looking for um, extra money to work less, or you want to retire early, or you just have other things that you want to spend your money on. So you want your money to grow for you without you having to put as much into the accounts themselves. But those extra returns beyond the benchmarks that we've kind of already laid the groundwork for don't come with either a lot of extra work or a lot of extra risk, and sometimes both. So it's really, you don't want to fall behind those benchmarks. If you focus on the things that you can control and you get those types of levels that you're entitled to getting just by owning some of these investments that cost essentially nothing, like Daniel was talking about, then you know you don't have to worry about shooting yourself in the foot and having to work longer than you need to, or not being able to afford some of those things that are really important to you. So,
So you mentioned risk and time. So alternatives potentially costing you in the form of added risk and or added time. What do you mean by that?
yeah, well, let's first maybe define some of these flashy trends or alternatives that we're talking about. So, that could be private real estate syndications or investment funds. It could be meme stocks. It could be crypto. What are some other examples that
I
you can think
mean,
of, Daniel?
GameStop and when it was hyped up by
Yeah.
Reddit and gold could be one, gold coins, gold, um, your buddy's investment deal, like because they know you're a doctor and they're like, I'm looking for investors. Um, there's did you say syndications and
Yeah.
real estate,
Yes.
especially if it's on a whim? Um,
Right.
these are
So,
not bad. Like we're not trying to say these are bad in themselves.
no.
First of all, this is just
Right.
examples.
And you might hear about them because they went through a period where they've done really well, where they did the 75% in a year, right? They
Mhm.
don't pop up out of nowhere. People wouldn't spread them if there wasn't at least a good recent performance period to point to and say, hey, look how well this did. These
Yep.
people aren't behind them aren't stupid. They're going to put a ton of money in spreading that once they've gone through a good period of time. But there's extra risk and extra time involved in these things. Um,
Yeah.
Extra time, we could start with that. I mean, there's a lot of these private types of deals, like the private equity or private real estate we talked about. There's extra time in the sense to just do your own due diligence on these things. Like, what are they actually doing? Sometimes that's a really hard conclusion to come to, where sometimes they don't have the properties yet. They're like, I don't know. Give me the money. I'll find a deal.
Yeah. We're gonna figure it out after you send us the check.
Right. So that also leads into extra risk a little bit there. Odds are, if something just had an explosion of really good performance, there's probably a lot of other people that see that. They're like, oh, I want to get into that market. So money comes rushing in. The market gets saturated. You've got a lot of people chasing returns, bidding up
Mhm.
prices on things, and for all of the extra time and the extra risk
Yep.
that you're accepting there, you might not get the extra returns that you are going through all this extra hassle for. Maybe your money is locked up now for 5 to 7 years in some of these things, and you can't access the money. So that's another really important piece, just locking up your money, not being able to access it. Now, with if it's like a retirement account, that's kind of another deal, right? You're getting some type of tax advantage for leaving the money in the account, but for some of these other alternative deals, where maybe it's, you know, we might refer to taxable accounts or non-qualified accounts, where typically you would have access to money if you're just investing in like the target date fund we were talking about. But if it's locked up in one of these private deals, that might not be the case.
Yeah, and also I would point out a lot of times these flashy, shiny object trendy investments. A lot of times that's where the just straight up schemes originate. Like if I'm not going to start a Ponzi scheme ever, but if I was a crook and wanted to start a Ponzi scheme, I'm not going to like label it as a boring passive investment. Like I'm going to make it super flashy. And so they kind of blend in with some of the legitimate, the stuff, the examples we've pointed out so far are all, they're not scams. They're just flashy. So, but typically within those flashy investments are sometimes just straight up schemes, like just straight up, um, unethical schemes. So that's, you got to kind of keep your eyes out for those. I guess that falls under risks, like added risks of those types of investments.
Yeah. And there are a lot of them, some of these private placements, right? You have to be an
Mm,
accredited investor. So you've got maybe a certain net worth or a certain income to even qualify for these investments. So it's almost like, are they, I don't know who they is, but the overlord regulating these things, are they saying, I know there's probably going to be some scams and schemes in here. Let's only let the people that can afford to lose the money in.
right.
I don't know if
Yeah.
that's true, but maybe that's a
Well,
safeguard.
yeah, it's an interesting thought. One of my favorite examples of like in a real, this is more mainstream example of this kind of shiny object trend was in 2007 with real estate. Like everyone and their mother was buying real estate property, typically like vacation homes, like multiple vacation homes, starting to rent them out. It's actually where a lot of legitimate businesses today got started, like that are successful today. But the problem then is like everyone was buying these real estate properties in like touristy spots to the point where at one point like they were doing this is when TV was bigger still, like cable or whatever. They were doing like TV commercials for like vacation properties that were coming up that you could purchase. And like it'd be like one out of every three professionals you talk to had their own, second or third home. And so everybody can look back and see what happened in 2008 and 9. Like they had, there was a big real estate crash and a lot of people lost a lot of money in real estate. Um, like 9 times out of 10 people got out of real estate because of that. Now, the 1 out of 10 that stayed into it has done pretty well. Um, but the point is like the mom and pop, like if you have to be careful with these things. Like 9 out of 10 is not very good. If 9 out of 10 are getting out because it's been so painful, um, that's a problem. Now, the 1 out of 10 were the people that were making it a business, like it was their profession, and they were doing it as for
Exactly.
a living. And even some of them got hosed, like a lot of them went bankrupt. But um, the people I know that stayed in it through the long haul, that are still in it today, like in real estate, all the way back till that were started around then, were all in on it. Like it was their profession, their business, and they were really good at it.
Yeah, and that's kind of the point too, right? Like you can't expect that from a boring index fund either. You can't expect to put the money in and it just to go straight up. Sorry, as soon as you put the money in, you're going to experience some period of time where the money is worth less than how much you put in. Could be the next day, could be a week from now, could be a year from now. But with your example, those people had a plan. They went into it treating it like a business. They weren't going to run away at the first sign of trouble. They were ready for it. They had plans for it. They treat it like a business. So, yes, you have to do that. You can't think it's just some magical investment that you can try once and it's just going to work perfectly. It has to be something that you believe in, you're going to put the effort in, and you have some reason to believe that if you stick with it over the long haul, it's going to work.
Let's take a quick break to talk about our firm, Wrenne Financial Planning. The goal of our podcast is to empower you to make better financial decisions. But sometimes the best financial decision you can make is to work with someone who understands your financial goals and has the expertise to keep you on track to reach them. That's where Wrenne Financial Planning comes in. We are a full service financial planning firm that works with over 400 physicians and their families across the country. We charge a transparent monthly flat fee for our services and offer virtual meetings you can take from anywhere. Best of all, you'll get to work with a team that specializes in working with physician families. So whether you're starting out and wondering how you'll balance your student loan payments and saving for a home, or you are an established physician trying to figure out how to pay for your kids' college and how much you need to save to reach financial freedom, we can help. I'll put a link in the show notes to schedule a no obligation meeting with one of our certified financial planners. Wrenne Financial Planning, LLC is a registered investment advisor. For more information about our firm, please visit wrennefinancial.com. That's WRENNE financial.com. So we get to see people's finances a lot, which is kind of a fun job in some ways. So what do you think of like new financial, like when we're seeing people's finances for the first time, how often are these kinds of investments, and we'll say for like established people, like people that are relatively established, like physicians that are relatively established, how common do you think these types of investments are, some portion of the investments for the typical physician?
Maybe 1 in 4 already have it. Like if we're
Yeah.
talking established clients, so maybe we could define that as 5 years out of practice or
Yeah. Yeah.
more, somewhere in that range. But maybe half are going to ask about it at some point, maybe even more than half. So that is something that we have to talk with people about.
Right.
Um, you know, I could tell you that there's at least one real estate fund that I know of right now that is talking about going belly up. So these things don't, real estate doesn't always go up. Some of these funds can go to zero.
Right. Yeah. And in my experience, so I would agree it's, maybe a quarter, maybe a half of new if clients' financial positions we're seeing, or not half of their total assets, but like half of the families we see have experience with these types of investments. The other interesting thing, I'm curious if you agree with this thought as well. I would say that majority, it probably is safe to say, maybe even like the vast majority of those investments are underperforming the plain Jane um, boring investment, like the target retirement date fund. Especially, I mean, if you have a long stretch of time to look at, I would say that's a pretty safe bet in my experience. Would you agree, Hugh?
Yeah, that's probably true. I mean, it's the variability in these things is so wide,
Right.
at
In
least from
fact,
what
it's
I've
pretty
seen.
rare that I see. I'm just, I can count on my hand like the times that I see people that are like really knocking it out on these types of investments. It's not that common, even though we see them all the time.
Right. Or maybe not paying out, the dividends that were originally thought going into it. Maybe some of those projections haven't worked out. But yeah, I haven't seen too many people that are so thrilled because they're knocking it out of the park with these investments. Often, sometimes it's hard to get a true read on like, what is this thing really like worth now today? Like, how
Like,
is it doing? You're really just relying on the investor relations and their quarterly email that they send out.
yeah,
Other than that, there's not a whole lot of information or a way to figure out exactly what is your investment worth until it's
right.
sold and you get money back.
Right. I mean, it depends on what. So, I mean, if you're investing in like a stock, like a hyped up stock, that's different. You can kind of see how it's performing. But like if you're investing in somebody else's deal, especially a private business, or you're doing your own real estate deals, or you're buying, a vacation rental, it's very difficult. Most people don't run the numbers on their own investments. Like most people don't know what the rate of return is on their real estate, for example. And a lot of times, it's hard to get concrete transparency from these types of deals. Maybe they just maybe it's ignorance, maybe it's just who knows, but they're not. I'm talking about compared to like a Vanguard target retirement date fund. They're about as transparent as you get. You get these, and it's regulated too. You get these reports all the time. You can easily check the return at any point in time, see exactly how it's doing, and that's not so easy to get in the we'll call it the shiny object world of alternative investments. But there's so many people. So, but despite all that we're talking about, there's tons of people that are investing in it. Why do you think people are doing that? Like, why are so many people continuing to invest in these?
I think income, like when people do an investment like in the stock market, they can see the investment change. But I think what there's something psychological to having money deposited, or at least the thought of money being deposited like a paycheck into your bank account, whether that's
Passive
dividends or rental income, right? Passive income.
mailbox money.
Um, right. For some reason, people view that differently than their account growing, even though you could click a few buttons and have it in your bank account. You're just choosing to let it continue to compound. I think for at least a lot of our clientele, a lot of the clients that I am talking to, they're maybe in their 30s and 40s. They have kids. They've got a lot going on. So they want to work less, maybe, or they at least want to be able to earn less in their day job because it's stressful. They see a lot of people throughout the day. They got all these things to juggle. And that's really appealing for them to think, oh, I don't have to have this job if I can build up this side income to come in and replace that paycheck. I think that thought of that is very comforting to them. Um, and maybe they don't quite realize or just don't have the experience with dealing with it until they get into it with managing a rental property. And then maybe that's only cash flowing couple $100 a month, right? And it's like, oh man, this is lousy. Like this is not what I thought it was going to be like. And now you have another thing to juggle, unless you want to hire somebody to deal with it, which is going to eat into your check anyway. So I think
Right.
that's why a lot of people get into it.
And the people that these are typically sold to, that's, well, not always, but this one good test of these is like who's making money on it. So sometimes you can kind of sniff these out by looking at where the money, follow the money, and you can sometimes get a good idea of the motivation. But um, with these kind of deals, they're often sold and they are very good at capitalizing or leveraging what Hugh just talked about with, like, say you're frustrated with work and you feel overworked and you want to have some freedom from your practice. You want to have freedom from medicine. You want to have financial independence. You want to have passive income. And I mean, we see those buzzwords all the time, especially with the ones that are really good. Like they'll throw in those buzzwords to catch the eyes of people that are struggling with those things. And I mean, that's the part I get most frustrated about. I get really like one of my most I really get frustrated when these deals say it's passive income. Like they say the word passive is a very frustrating word to see from my standpoint, because especially for the ones I know are not passive, because passive implies mailbox money, sit on your couch and you send them money and then get a check. And a lot of them, I know good and well they're completely not passive, and then they market it as like passive income, and that's just wrong. I mean, it's just incorrect. It's a lie at the end of the day.
Which types of investments are you talking about in particular?
Well, I mean, real estate's the number one that uses that. I guess there's potentially others, but real estate like is 99 times out of 100. All the ones I'm thinking of are real estate uh, deals or gurus or whatever, you
Yeah.
know, and they love
Well,
the
if you
passive income.
right. I mean, maybe if they just lean into like, hey, this is going to be some work to get set up initially, and then there's also going to be some ongoing work, and sometimes there are going to be some very poorly timed um, maintenance things that you need to do. And but in the end, if you go about it the right way, um, you're going to make some money. Maybe that's a better approach. That's not
Yeah.
easy to sell.
Yeah, right. That's what goes, I mean, that's why you got to look at who's making money or what the deal is. So if the person, another reason, I think one of the biggest reasons people get into these is that they've heard it's a good idea, right? I mean, most people aren't finding these kinds of deals. In my experience, most people are not like going through the universe of investments or the universe of like private business deals across the country, because there's a zillion of them, but most people are not even going through, they're going through none of that. In reality, they're like hearing from a friend or like from an influencer they follow or something. Like it's coming to them, I guess is what I'm trying to say, instead of they're finding it. In most cases, it's coming to them. And so you got to ask the question, well, how's it getting to you? You know,
Mhm.
because things
Yeah.
don't, a lot of cases, it's people are getting paid along the way to push the idea. And I'm not against people getting paid. Like you have to make a living and the business has its purpose. But I'm again, I think I'm more against the lack of transparency. So the problem is you don't realize they're getting paid sometimes. And so they appear to be objective and have your interest in mind, when in reality, they're making a lot of money by you doing the shiny object.
Yeah. And you want to make sure they have skin in the game too, right? Like what's in it for them if this deal goes bad? Do they have something to lose? Do they have personal money invested? Um,
Right. Yeah. Yeah, ideally they for sure have some skin in the game for the person. But there's a lot of people that are just, gurus, and especially in real estate, that just kind of talk about all the ideas and stuff like that, or influencers nowadays. And the influencers, they're just getting paid by people, the companies, to sell the shiny objects, essentially, you know? So, I mean, not all their ideas are bad. I'm not trying to say that, but it's just good to know people are getting paid to push ideas. And so maybe you do a little second, get some second opinions on that kind of thing, or do your
Yeah,
homework. And
just make sure you right size it, right? I mean, hey, if you're well off and like you've done great financially, you've got lots of wiggle room in your budget and you want to carve out 5 to 10% just because you like some of these things and you want to take a swing for a home run, cool. Just know what you're doing.
Mhm.
Just know that that's what it is. And don't be disappointed if there's a strikeout there. Um,
Right. Yeah. It's best not to like put all your eggs in one basket, like with your retirement, say your retirement bucket of money that's going to be used for, or whatever goal it might be. Ideally, you kind of have all that zipped up, and then you have some extra, like he's talking about. That's a really good way to look at it if it's like extra money, or you're okay with potentially losing all the money, and you enjoy it. Yeah, it's not a. But I mean, then I would ask the question, well, why would you want to? I mean, do you really want to throw away money? Do you still want to make sure it's a good investment, I guess is what I'm trying to say. So I wouldn't just
yeah,
jump in.
yeah, yeah. And the accessibility component can be huge too, especially if you're more goals and values oriented type person and you want to leave room for opportunities for things like quick personal anecdotes. I mean, I know we, maybe one person in my house in particular had a little bit more interest in investing in some of these things, real
Uh,
estate, like private funds, right? And just through some education and due diligence, we decided not to. And without that, if we had put, some of our non-retirement money in this thing, one of the best moves I've ever made wouldn't have been possible. So, I mean, at the end of my wife's 5-year contract out of residency, um, we made a very long move and we were able to um, buy a home within our price range that had something super rare and unique about the area we were moving to because we had access to non-retirement investments that we could sell with the click of a button and have it in our bank account in a week or less. And we could do all that um, as a second home mortgage, which, by the way, no one should have ever allowed us to have these two mortgages indefinitely. That would have been a horrendous idea.
Bad
We
move.
we do not have it like that. But because we had access to that money, we were able to do this and move to somewhere for just a better life for our family. And yeah, if we had that money locked up in a private real estate fund, we wouldn't have been able to do that. And let's just say maybe that money would have done better. We still couldn't have done this. And so what? We don't have an extra whatever. Pick your number, 10,000 bucks or whatever. It doesn't matter. That wouldn't have changed our life the way this did. So I think that's a really important piece to look at things as well. It's not just what the returns were, it's just taxes play a component, fees play a component, and access to the money for important things that come along the way. There could be surprises, there could be opportunities that you never even thought were going to come, 3, 4, 5 years from now. And just having the flexibility for that is huge.
He was a good team player. It that's a perk to being married to a financial planner, I'd say too. But like the financial planner, a lot of financial planners I know would be like their spouse. as interested in something, they're like, no, that's a bad, like terrible, no, end of discussion. And that's not the right way to do it. So, had the way you guys educated yourselves and kind of went through the due diligence and kept an open mind. That's the right way to do it. And, you can, if you understand it fully, you kind of come to your own conclusion. Um, we can tell you, keep an eye out for these, but at the end of the day, the best way to do it is to educate yourself, and then you'll really understand it. And you can kind of apply it to your situation. And so kudos to you for doing it the right way.
Yeah, hey, we spent some money on some courses that which, has its own incentives, but um I mean,
Right.
I'm open to the idea in general. It's just when the time is right.
What did you think
Um,
of the courses? I mean, we're not going to
gosh.
name specific courses because I know which courses you took, so let's probably stay away from that. But
I mean, I definitely learned a lot. I learned some things that I can apply now of other clients are like, hey, like this ended up in my email inbox. What do you think of this? There's a
Mhm.
structure for going through and looking at things and understanding what you're getting into is huge. And then you can apply it to your own situation. That was the biggest thing that I took away from it. The other thing, too, with more of I think so far we've been talking a little bit more about like the private real estate deals where you put the money in, you're not actually buying the properties. Like you're just a limited investor. But some of the other ones about buying real estate property, um, you will learn quickly it's not as easy. You might have to look at 100 different properties before you find one where the numbers will work.
Yeah.
And then you'll find something else why the numbers work because there's this problem with it. And then you got to go through another 100, or you have to like think creatively about the ways you could change it or make an extra bedroom, which goes for an extra few hundred a month in the area and those types of things. So it's a lot of work. It's a lot more work than I originally thought it was. So it was eye opening.
Yeah, and it's stress too. One other little tidbit I'll throw out there with this, I think some of the shiny objects we've been talking, we've kind of leaned towards real estate. There's a lot of things we didn't hit on, like crypto was one. I think we threw that out there, but like
Yeah.
that's a good example of one. But I think back to some of the ones I've fallen for, like in fact, the first shiny object I fell for was when I was 15 years old. And in fact, it was my first investment ever. uh, and I bought tech stocks in 1999 or 2000. And so if you're curious, you can go look back, check out Cisco, the chart on Cisco, the stock CSCO, I think is the ticker, and look all the way back. So if you look, it's like bing, way up, and then down, way down. And then it's slowly been recovering to the point where it's not quite to where it was in 2000, even today. And so I bought it back at the top of that spike way back in 2000. And then I sold it at the bottom of the spike. So that was when all the tech stocks got all hyped up, and then they all fell, dropped, and then uh, I basically lost my money in that. But um, that was so. What I was going to say is the one thing that I notice about the difference between that and the way that I invest now is I got the same like gut feeling, nervousness, excitement that I do when I had a stint where I would go to the casino. I don't do that anymore, but when I was younger, anybody that's played blackjack or something like that, it's kind of exciting. It's extremely exciting, actually. And then it's this up and down emotional roller coaster. And so I identified the exact same feelings with that investment as I had felt at the casino because it was basically the same sort of investment. It was a gamble and it was very volatile. So that's a good like signal of maybe you're a little in over your head with this investment. It shouldn't, or maybe it's a potentially a gamble if you're feeling that nervousness, excitement, roller coaster ride. And I know some guys that are in crypto now that are feeling that with a large amount of money. And it's incredible. They're like mega millionaires, but they're stressed out to the wazoo. Because if you can imagine, like if you have $20 million worth of crypto. Have you seen how volatile crypto is? Like it goes to half and then doubles and then triples and then it's incredibly stressful to watch all of your wealth get cut in half or double or whatever. It's a roller coaster.
Yeah, that's another important element of it too. Like just the mental toll that it takes with something like that.
Yeah. And then the other example I have was real estate. So I wanted to become a real estate tycoon at some point in my life. I had bought a rental property or lived in a rental property with originally I lived in it with my buddies. This was like right out of college or a few years out of college. And then I started renting it out to someone else. And then I got married and I didn't really quite realize the stress it was causing, but it was definitely causing stress to the point where my wife and I would have arguments. I think we hit the max when the tenant she started helping me deal with it, called her and asked if we could have goats in the yard or something like that. And this had been after a stretch of like, there's water leaking and I had to go over there and plunge a toilet because she didn't know how to plunge a toilet. And there was literally water leak. I'm like, what? She was like, mass flushing the thing and water everywhere. And anyway, it was a massive headache. I was still going to keep it, but because I wanted to be a tycoon. But my wife, fortunately, in that example, knocked some sense into me and helped me realize we needed to get rid of it. So,
What wives are for.
yeah, I mean, sometimes we'd have the reverse play out, but yeah. Sometimes you don't realize it. It helps to have other people in your life. That's another thing, like having other people to that's kind of what I think our role is sometimes as the financial planner. We're like, hey, bro, like that. Have you thought about it this way?
Oh yeah, everybody has their blind spots.
Right. A different perspective. And, you know, and then sometimes you're like, yeah, that is a good point. Goodness gracious. So awesome. Well, any parting thoughts? Anything we missed? Any awesome shiny objects to recommend? Just kidding.
Uh, no awesome shiny objects recommended here. Just if you're gonna do it, right? I'm not like Daniel, total fun police. He doesn't go to the casino anymore. Just if you're gonna do it, you have a set amount of cash that you're gonna put in. You know, hey, if this goes to zero, this is not gonna change my life. Don't, do anything beyond that.
Right. The problem was that was so boring at the casino to do that. I didn't do very well with moderation. I'm like, it will be best to do the avoidance policy with this one. So,
To each their own.
yes, everybody's different, so everybody can apply it to themselves. But all right, Hugh. Well, I appreciate you coming on. It's been fun, as always.
Of course, always fun.
No guests or clients appearing on the podcast received any form of compensation for their appearance and obtained no other benefit from us. It should not be assumed that every client has had the same experience.